Good morning, and welcome to Financial Fridays. Last time we covered the basics on what a stock is and how they function. Today we will be covering the different types of stocks and how to tell what type of stock is best for you. So, what types of stocks are there? There are mainly two types of stocks in the market: normal stocks and dividend stocks. In the last video, we went over how the stocks work, and all the things listed in that video apply to both types of stocks, dividend and normal stocks alike. Let's cover a little on what dividend stocks are. Dividend stocks will pay you a percentage of their stock's worth in payment periods. These payment periods are usually every quarter, but they can vary. The amount the stock pays out compared to their profits and their average growth also plays a factor in what the base stock is worth. However, it is fully up to the company on what they will pay out as a dividend. There are some dividend stocks that get up to 25% payout rate, but these stocks are normally very high risk. So they use the high dividend rate to get investors to buy the stock and hold it. Not all dividend stocks are risky, but you get your return on investment from holding these stocks longer as the company keeps paying the dividend. That is a general overview on what a dividend stock is. With that knowledge, we can begin to figure out what type of stock is best for you. Normal stocks mainly grant you income if they increase in price, while dividend stocks can grant you income while remaining close to the same or even dropping in price. So what type of person are you? Do you like to keep a close eye on the markets for things that you are interested in? Do you want something you can buy but only have to check every so often? Let me give you an example. I myself am a dividend investor, or what the field calls a drip investor. I buy stocks that seem decently stable with some room for growth and have shown growth. Now, I go for the riskier stocks with a higher percentage dividend and keep an eye on them every so often. The ones that I invest in pay around 17% annually and around 4% quarterly. I don't intend to sell these stocks even if they keep falling for a while or when they shoot up in price. I use the dividend that I am paid to reinvest in the stocks that I have. For me, this is less mentally taxing because as long as they keep paying the dividend, it will balance out and earn me profit in the end, barring the stock going bankrupt. Normal stocks will need you to keep more of a watch on them and see how the market and stocks have been trending. For these types of stocks, I would recommend that you only invest in fields that you are familiar with. That way you have a general understanding of the market and how the market will react to new products and new releases. For example, when I knew Nvidia would be coming out with a new graphics card line, I knew that typically people would panic when they heard the news, and even more on release day. So I waited for the market to drop, and then I bought what I could, because I knew the stock would bounce back even if the product did bad at first, because I knew the brand and I knew the company would make sure to fix any problems quickly. Typically, the people that buy low and sell high are normally referred to as traders or trade investors. This type of stock requires more continual research and observation to be able to make the most of it. However, dividend stocks and dry stocks can be treated both as buy low and sell high, or invest and hold. Each one has a style that works best for them, but is not excluded from the style of the other. So do you want to be a trade investor, or do you want to be a drip investor? Both require a good amount of research, but traders need to stay on top of the market, while drip investors just need to check in every so often, or to set alarms to be notified when a stock drops X%. If you are someone who always reads up on the latest news on a field, and do not mind the stress of deciding if it will go higher before you sell, or lower before you buy, then I recommend trade investing. If you are someone who does not mind the front-loaded research, and seeing your stock drop 10% one day, and rise 20% the next, because you know it'll balance out in the end, someone who is okay holding onto the stock for long periods of time, then I recommend dividend or drip investing. Now, as a side note, stocks that are sold before having owned them a year will be subject to normal tax laws, while stocks that are held for over a year will be taxed under a 15% tax rate when sold. Next week I'll be covering how to budget for investing. This has been Financial Fridays with Kyle. I look forward to seeing you Monday. Thank you.